S-Reits had a strong start in 2020 after enjoying returns of some 28% in 2019. However, concerns surrounding the COVID-19 crisis prompted a sharp sell-off mid-March. Since then, prices have rebounded on hopes that government stimulus will support the economy. There are also hopes of a vaccine against the coronavirus.
S-Reits declined about 22%, but if we compare that against other REIT markets which fell as much as 40%, in comparison, S-Reits didn't fall as much, and perhaps a part of the reason is because of the diversified nature of S-Reits. There are S-Reits today with healthcare and data center assets which have been beneficiaries of the current environment.
We expect there to be a negative outlook for Singapore REITs this year across most sectors. Of course, the impact of the sort of global economic downturn will be slightly different depending on the types of assets that the S-Reits hold. For example, REITs that have hospitality and retail assets are likely to perform weaker than REITs that have industrial and office properties.
Singapore's 44 REITs and property trusts offer wide diversity across property sub-segments. Analysts say that divergence in performance between these sub-sectors is likely to become more pronounced.
Industrial is where we see impact being most minimal in our view. Downside, estimates compared to pre-COVID levels are less than 5%, while we have cut our estimates for retail, for hospitality between 20 to 40%.
On a year-to-date basis, S-Reits have declined 15% on a total return standpoint. There were in fact 3 S-Reits that generated positive returns this year. Keppel DC REIT and Parkway Life REIT both have exposure to essential services with their healthcare and data center assets. Keppel DC REIT noted that data traffic has been a lot higher as people work and transact more from home. Mapletree Logistics Trust mentioned that tenants that are hardest hit by COVID-19 include your retail, hospitality and travel industries, whereas tenants that serve your daily essential needs, meaning to say your e-commerce operators, they continue to see healthy levels of activity.
But with consumers staying home during the circuit breaker period, could e-commerce hurt footfall at retail malls?
For the retail exposed REITs, we do not think that e-commerce would be a big threat for them. Although that during this COVID-19 period, we do see a lot of demand from online shopping. However, as the shopping center floor space per capita remains small in Singapore compared to other developed markets, and also due to the high population density in Singapore, we think that these will support footfall to the retail shopping malls.
Amid a challenging operating environment, S-Reits have been thrown a lifeline. Recently introduced regulation will help S-Reits access various funding options and manage cash flows.
On the back of this new COVID-19 temporary bill, I think we expect some retailers, some tenants to go under this bill, ask for some delay in their rental payments in the near term. As REITs, you have to pay out most of the cash flows per year, every quarter and promptly. This put in a risk where cash flows and revenues, there's a little bit of a mismatch in the near term. And I think the response from the issuers is to make use of this new rule by MAS to just try to match the cash flow and dividends, especially in the next 1 or 2 quarters. We'd like to highlight to investors that whatever you're seeing currently is not a cut, but rather a delay in the dividend.
One of the key challenges from a financial perspective is liquidity, because S-Reits have to, as per the tax regulations, they have to pay out at least 90% of their profits as dividends, so they hardly retain any cash. And therefore, repaying debt is one of the key risks that S-Reits face. If they are allowed to retain the cash, at least in the next 12 months, which is what the regulation allows through 2020, they should be able to sort of divert that cash to repay debt or preserve liquidity and the like in this downturn. The other measures in terms of increasing the leverage ceiling and deferring the interest coverage ratio requirement, both will allow sort of S-Reits to manage their balance sheets and their financial risks.
Analysts believe that when the dust settles, potential returns from S-Reits still look promising.
The pickup of share prices, we will see them potentially in the second half of the year. We would expect somewhat of a near-term bottom within the next month or so. I think the return will be slow and steady, but the return will certainly be there.
In the long term, we think that investors who are willing to look beyond COVID-19, value emerges in these retail exposed REITs. Retail exposed REITs could recover faster than, say, for example, hospitality REITs, because part of the tenant mix are related to the non-discretionary spending, such as supermarket, food and beverage, and also some of those experiential experience that offer the cheaper form of entertainment, such as arcade, karaoke, and movies. So this part of the retail sector should pick up faster than the rest.